Welcome to Theta Fuse. If you woke up this Friday, January 16th, 2026, and thought everything was, stable, you might want to think again.
Yeah, you might want to check the foundations.
Because this week wasn't just about the usual market ups and downs. This was about a series of, well, they felt like geopolitical earthquakes.
And domestic power grabs. The markets were definitely reeling.
Right. U.S. stocks are wobbling. You still have that background tension with Iran. But the real story, the one we're diving into, is how the very structure of global trade and finance seems to be fracturing in real time.
It's been an exceptional week, really defined by institutional stress. I mean, we're used to markets reacting to jobs data or an inflation report.
Sure, usual stuff.
But this week, capitals was moving because of raw political risk. When trust in your core institution starts to go, whether that's your central bank or a key trade alliance, you see this profound, almost instantaneous flight of capital.
And that's exactly it. That's the insight. This isn't just some cyclical downturn. We've pinpointed three massive interconnected shocks that suggest a really deep crisis of trust. This is what our deep dives are all about, right? Looking past the headlines to see what's really shaking the system.
And the sources couldn't be clearer about this triangle of instability.
Okay, so shock number one, and this one is frankly deeply concerning. We're seeing a direct, open assault on the Federal Reserve's independence.
And this isn't just, a president tweeting criticism.
No, it's active interference in who leads it. It's using government power to apply leverage. It challenges the whole idea of what a central bank is supposed to be.
Then there's the second shock, which is the market's primal scream in response to that, gold, the classic fear gauge. It didn't just climb, it blasted past historic records. We're talking just over $4,600 an ounce.
An absolutely massive number.
That rally is the clearest barometer we have for just how little confidence there is in political and currency stability right now.
And the third shock, which has these huge geopolitical consequences, is watching North America start to look less like a solid alliance and more like just a collection of actors looking out for number one.
The Canada deal.
The Canada deal. Prime Minister Mark Carney has publicly broken ranks with the U.S. on China policy, of all things, announcing a huge deal to let in Chinese electric vehicles.
So, the central question we have to grapple with, based on all this, is pretty profound. Which do global investors think is more stable right now? The decades-long political alliance of the Western world, or a lump of yellow metal?
And right now, the answer seems to be the metal.
The answer is gold.
So we have to unpack this. Is the Fed being deliberately politicized? Why is Canada, our closest ally, suddenly choosing Beijing over Washington on something as critical as EVs? And what does this panicked scramble mean for the U.S. dollar as the world's reserve currency? Let's start this deep dive where the chaos began, inside the Federal Reserve.
Let's do it.
Okay, so let's set the stage. The drama around who will be the next Fed chair. Jerome Powell's term is up in May, and the speculation has been just intense. The frontrunner was widely seen as Kevin Hassett, who's the director of the National Economic Council.
Right. And the market view on Hassett was that he would be a more dovish pick.
Explain what dovish means in this context.
It just means he'd be more inclined toward policies that stimulate the economy, prioritizing jobs and growth through lower interest rates, even if that means a little more inflation risk.
As opposed to a hawk who's all about fighting inflation no matter what.
Exactly. And markets tend to like dovish candidates because it signals easier money, which is good for stocks.
Okay, and that expectation is key because of President Trump's sudden hesitation. And the reason he gave is just, it's unbelievable. It had nothing to do with Hassett's policies.
Nothing at all. It was about his communication skills.
His communication skills.
That's the really astonishing part from the sources. The president was reluctant to nominate Hassett because he was worried that moving him from the NEC would mean the administration loses, and I'm quoting here, one of its most powerful messengers on the economy.
A messenger? He's more valuable as a public advocate than as, the head of the most important central bank in the world.
The quote is even more direct. Trump apparently said to Hassett, "I actually want to keep you where you are. If I move him, these Fed guys, certainly the one we have now, they don't talk much. I would lose you. It's a serious concern to me."
Wow. I have to stop on that. He's saying the Fed doesn't talk enough for him. Is he looking for someone who can go on TV and sell the administration's economic record?
That's precisely the fear that a quote like that triggers. It turns the Fed chair selection from a serious policy decision into Well, a political casting call.
It's pure politicization. You're not looking for the best guardian of the dual mandate. You're looking for the best communicator for your political agenda.
And the market, which prizes the Fed's independence above almost anything else, reacted instantly to that uncertainty.
So let's track that fallout. When it looked like Hassett, the dovish pick, was maybe out, gold actually slipped a bit, 1.7%. The dollar recovered, Treasury yields went up. Why that immediate reaction?
Because the market suddenly had to price in a different possibility. If the dovish guy is out, maybe a hawk is in. The prediction markets, like Poly Market, just shifted on a dime.
And who became the new frontrunner?
Former Fed Governor Kevin Warsh. His odds just shot up to 54%, Hassett's cratered to 16%, and Warsh is generally seen as much more of a hawk.
Okay, so help me square this. The broader market is screaming fear, right? Piling into gold. But the prospect of a hawkish Fed chair, who might raise rates, caused gold to dip. How do those two signals coexist?
That's what's called the confusion premium. The very brief gold dip was a knee-jerk reaction to a potential hawk. Hawkish Fed means a stronger dollar, which is usually bad for gold prices. But the bigger picture, the overriding force, is the instability of the whole process, the sheer political chaos. When you don't know who will be in charge or what their real mandate is, the long-term bet is always on safe havens. The nomination drama itself is a much bigger risk signal than who might be in the chair next month.
And this whole succession mess is happening while there's this other, more structural assault on the Fed going on.
Exactly. It's not happening in a vacuum. You have this backdrop of really aggressive political moves.
Right, like the Senate confirmation process being held up. Senator Thom Tillis is vowing to block all of the president's nominees.
Any nominees. He's holding them up until two things are resolved.
Yeah.
Some kind of Justice Department investigation into the Fed and this really controversial move to subpoena the central bank.
Wait, how can the Justice Department, which is part of the executive branch, investigate or subpoena an independent body like the Fed? What's the pretext?
The pretext is usually framed around things like financial oversight.
Yeah.
Accountability for spending. Critics have seized on the Fed's big, multi-year, $2.5 billion renovation of its headquarters in Washington.
Ah, the renovation.
Right. The Fed says it's necessary infrastructure work, but political opponents see that huge price tag, and they call it waste and a lack of transparency. And that gives them the administrative cover they need to launch an inquiry or issue a subpoena about the use of public funds.
So it's not actually about monetary policy. It's about using an administrative tool as a political weapon. It's pressure by proxy.
That's it, exactly. And Chair Powell himself called it out. He decried the whole probe as a barely veiled attempt to undermine their independence.
So the implication is, if the White House can use the DOJ to pressure the Fed over its budget, what's to stop them from pressuring the Fed over interest rates?
It fundamentally changes the game. The Fed's dual mandate is price stability and maximum employment. This effectively tries to add a third unstated political mandate.
And this couldn't be happening at a worse time, because inside the Fed itself, there's a huge disagreement about what to do next.
A major policy divergence. On one side, you have several of the regional Fed presidents signaling they're ready to pause any more interest rate cuts at their next meeting on January 28th.
And what's their reasoning?
It's sound from their perspective. They're looking at inflation pressures that are proving to be a bit sticky and a labor market that looks like it's stabilizing, not falling apart. So they're saying, let's just wait for more data.
Don't rush into another cut.
Right. Don't risk reigniting inflation. But then you have a completely different argument coming from the very top.
From Vice Chair Michelle Bowman.
Yes. And she's seeing signs of fragility that the regional presidents might be missing. She's looking at the forward-looking indicators.
What specifically?
The recent drop in job openings. Her warning is that there's a tipping point. Right now, companies are just slowing their hiring. But once they switch to actively cutting jobs, the situation can deteriorate really, really fast.
So she's saying the Fed needs to be proactive, not reactive.
Exactly. She argues the Fed should be ready to cut rates further, to get ahead of that, to prevent a rapid collapse. She's saying, don't wait for the fire alarm, be ready to pull it.
So you have this dangerous gridlock. Some governors are looking at the current data and saying, hold the line, while the vice chair is looking at future risks and saying, be ready to flood the system.
And you combine that internal conflict with the external political drama, and you get an institution under just maximum stress.
And when the institution that's supposed to guarantee the stability of the world's reserve currency is under that much stress, where does the smart money go?
It runs to things that can't be politicized.
It runs to safety, which brings us right to gold.
And right now, safety looks very, very shiny.
The surge in precious metals is just the clearest market signal of this instability. Gold trading above $4,600 an ounce. I mean, say that number again. 4,600. It feels unreal.
It is a historic peak. It hit $4,634.55 this week. And you have to understand, this isn't about industrial demand. This is pure confirmation that the fear premium is through the roof.
And our sources point to two main drivers, right? Both tied directly to the Fed drama.
Inextricably linked.
Yeah.
Driver number one is just the renewed White House attacks on the Fed's independence. Investors see that, and they see a direct threat, so they move into gold, which has zero counterparty risk.
And driver number two
is the expectation of monetary easing that comes from that. Either the Fed gets pressured into cutting rates, or Vice Chair Bowman is right and the economy weakens. Either way, the outcome is a weaker U.S. dollar.
And gold is the classic hedge against both political chaos and a devaluing currency.
So what you're seeing is the market pricing in the loss of the U.S. dollar's independence premium.
The independence premium, I like that. For decades, the dollar was strong not just because our economy was big, but because our institutions, especially the Fed, were seen as neutral and competent.
Exactly. That trust is the bedrock of its reserve status. When the political risks in the country that issues the currency get too high, when you have threats of random tariffs, when the central bank is under assault, global players from other central banks to huge investment funds, they have to diversify.
And this gold surge is just proof that that diversification is happening right now, at speed.
It's a massive deepening currency trust deficit.
Okay, so gold is one story, but silver. Silver is behaving like a volcano. It topped $89 an ounce, still up over 15% for the week. This is more than just fear. This sounds like a squeeze.
It's a classic short squeeze, absolutely. It's layered on top of all the same geopolitical fears, but the silver market is thinner, it's more volatile, and easier to push around.
So for anyone listening, what is a short squeeze in simple terms?
It's when a bunch of traders bet that the price of something, in this case silver, is going to fall. They short it. But if the price starts to rise instead, they get trapped. They have to rush to buy silver to cover their bad bets, and all that forced buying just sends the price rocketing up even higher.
And who is the main engine behind this chaos?
Well, according to the commodities strategists, the main engine seems to be speculators in China. The evidence is just exploding trade volumes in their mainland futures markets. It's high-frequency, high-volume trading that's trapping the short sellers.
And that kind of intensity got an immediate reaction from Beijing.
Oh, a very sharp and immediate clampdown. Chinese regulators, led by the Shanghai Futures Exchange, made two big moves. First, they lowered position limits, which is pretty standard. It just means traders can't hold as big a position.
Okay, that makes sense. But the second move was much more aggressive.
Much more. They ordered the physical removal of servers operated by high-frequency traders from the data centers.
They literally unplugged them.
They literally pulled the plug. It's not just a rule change. It's a physical intervention. High-frequency trading depends on being milliseconds faster than everyone else. By kicking their servers out, the regulators physically slowed the market down. It shows you just how worried they were about their own domestic speculators causing a global meltdown.
That's incredible. But the silver price also has a geopolitical angle that ties back to U.S. policy, right?
It does. There's this constant background noise about U.S. tariffs on critical minerals. The sources point out that even though President Trump paused those duties this week, the threat alone was enough to make people hold silver supplies in U.S. warehouses.
Why would they do that?
As a hedge. You keep the physical metal onshore in the U.S. to avoid potential future tariffs or to back your futures contracts. But the effect is that it takes physical supply off the global market. That distortion made the global short squeeze even worse last year, and it's helping keep prices high now.
And this all feeds back into that narrative of an unpredictable U.S. You mentioned the Greenland tariff threat. The idea of putting tariffs on countries if they don't go along with a plan to acquire Greenland.
Right. I mean, when you have that level of unpredictability, it's no wonder that, as one strategist said, every major forecaster is bearish on the U.S. dollar going into this year. This precious metals rally is just that forecast coming true.
Capital is fleeing the U.S. dollar system because the country issuing it is seen as an unreliable partner.
And that sense of self-interest, that search for alternatives, it leads us perfectly to the moment Canada decided its interests were no longer perfectly aligned with Washington's.
This might be the biggest geopolitical pivot of the week, a real crack in the North American foundation. On Friday p.m., Mark Carney announced this landmark deal with President Xi Jinping in Beijing. And it's a deal that directly reverses the old policy of standing with the U.S. against Chinese EVs.
It's a huge de-escalation by Ottawa. You have to remember the context. The previous government put a 100% tariff on Chinese EVs back in late 2024. They were under intense pressure from the U.S. and Europe to block these subsidized cars. Carney is now making a hard pivot to what he's calling value-based realism.
Let's break down the deal itself. It's a very specific trade-off. What is Canada giving up?
They're giving China a managed but crucial foothold in the North American auto market. They're going to allow up to 49,000 Chinese EVs per year. And that punishing 100% tariff, it gets slashed to just 6.1%.
6.1%. That's basically nothing. It normalizes it.
It completely normalizes it.
Yeah.
And he built in a clever political component.
The affordability piece.
The affordability piece. He specified that by 2030, half of those imported cars have to cost less than $35,000. So he can sell this to Canadians as a solution to the cost of living crisis.
Okay, so that's what China gets. What does Canada get in return? Because this is clearly about self-interest.
It's all about agricultural relief. Chinese retaliatory tariffs have been absolutely devastating for Canadian farmers.
And the relief is immediate.
Very. China is dropping canola seed duties from a crippling 84% down to 15% by March 1st. That is life support. And on top of that, they're suspending tariffs on Canadian canola meal, lobsters, crabs, and peas for the rest of the year.
And the sources really highlight how desperate that sector was. Those tariffs had completely stopped all pea shipments to China. That was a $700 million market, just gone, replaced by Russian products.
And farmers need this certainty right now as they're making their seeding decisions for the spring. This is a massive win for the prairie provinces.
But this deal has created a huge political split inside Canada itself. It's pitting industry against agriculture.
That's the core of the fight. In Saskatchewan, the Premier Scott Moe called it very good news. He's thrilled. But the fury is coming from Ontario, which is the heart of Canada's auto industry.
Right. Ontario Premier Doug Ford slammed the deal, and his argument isn't just about jobs. It's about the risk to the entire U.S.-Canada relationship.
His fear is that by giving China this low-tariff entry point into North America, it risks, in his words, closing the door on Canadian automakers to the U.S. market.
Wait, how could a deal with China close the door to the U.S. market? They're supposed to be our partner under the USMCA.
Because of the exact unpredictability we've been talking about. If the U.S. sees Canada creating a backdoor for subsidized Chinese EVs, Washington could easily argue that Canadian-built cars are now compromised and slap new tariffs or restrictions on them. Ford is basically begging the federal government to realign with the U.S. before it's too late.
So Carney is framing this as value-based realism, the world as it is today. This is a huge shift for him, right? A year ago, he was calling China the biggest security threat.
It's a complete realpolitik pivot. He looked at his closest ally, the U.S., saw extreme unpredictability. And he made a cold calculation. The economic certainty from China's agriculture market was more valuable than the geopolitical risk from an angry Washington.
So the big debate is this a smart move by Canada to protect itself from U.S. protectionism? Or does it just fatally undermine the entire Western effort to counter China's EV dominance?
It almost certainly undermines it, at least for now. The U.S. and Europe are trying to build these high tariff walls, and Canada just installed a low tariff gate. It's another signal that when the leader of the alliance is seen as unreliable, self-interest will always win.
And that erosion of confidence, that fragmentation, it's hitting every sector. Which brings us to our final segment on the corporate blitz.
From geopolitics to the boardroom.
Let's start with the battle for the future of AI. Elon Musk versus OpenAI and Microsoft. The lawsuit is officially going to trial.
That's right. The judge refused to dismiss Musk's core claim. And his argument really comes down to a betrayal of the mission.
What's the core of that claim?
He's arguing that OpenAI, which he helped found, was supposed to be a nonprofit, a charitable trust-building AI for the good of humanity. He claims that when they took billions from Microsoft and became a for-profit monster, they violated that original promise.
This trial is so important because it's about the governance of this incredibly powerful technology. It's another crisis of institutional trust, but at the corporate level.
It is. Musk is essentially asking the courts if foundational, publicly beneficial research can be co-opted for private corporate gain. OpenAI, of course, just calls it baseless harassment. Yeah, but this is going to get very messy.
Now let's shift to the direct consequences of these U.S.-China tensions and look at the king of AI chips, NVIDIA.
The political environment is costing them a fortune. The sources confirm their China revenue dropped 45% year over year.
45%.
A staggering number. It's a direct, quantifiable cost of this geopolitical chaos. The U.S. puts on restrictions, China retaliates, and a U.S. company pays the price.
And the Trump administration's attempt to sort of thread the needle by allowing sales of the H200 chip with a 25% tax, that didn't work.
It seems to have failed. Even with that approval, China is reportedly blocking general imports of those advanced chips anyway. This is what analysts were calling the nightmare scenario for NVIDIA.
And the bigger long-term risk is that this forces China to get good at making its own chips faster.
That's the great irony. The policy designed to slow China down might actually be speeding them up. By cutting them off, we're forcing them to invest billions to build a domestic industry, which will eventually become a major competitor to NVIDIA.
Okay, moving from high-tech to your monthly bills. Spotify. They are proving that in this chaotic world, if you have a sticky subscription, you have serious pricing power.
Immense pricing power. They just announced another round of hikes. The individual plan is going up another $1 to $12.99 a month.
$12.99, Duo is going up, Family is going up, even the student plan is going up.
It shows that in an inflationary environment, people will cut other things before they cut their established habit-forming services, and the financial impact is significant.
What are the estimates?
Evercore ISI estimates these hikes alone will boost their sales revenue by 4 to 5%. It's a reliable way to generate more cash in an unreliable world.
Let's quickly hit retail and housing before we wrap. A big executive shakeup at Walmart.
A very significant one. John Furner is taking the top CEO job, but the key move is David Guina becoming CEO of Walmart US.
And his background is the real story here. He's an Amazon guy.
Spent nearly a decade at Amazon. This signals that Walmart's #1 priority for its U.S. business is winning the war against its biggest e-commerce rival. They're bringing in a veteran of Amazon's culture and strategy to fight them head-on.
And finally, housing, the biggest cost for most people. Is there any relief in sight?
It's starting to look that way, but for negative reasons. Home builder sentiment just dropped for the first time in 5 months.
And why is that?
Affordability. The builders are seeing that lower and mid-range buyers are just tapped out. The combination of high prices and high mortgage rates is finally hitting a wall.
So the builders are having to offer incentives to move inventory?
They are. The sources say 40% of builders cut their prices in January. The average cut was 6%. That's a big deal.
Yeah.
It tells you the power is starting to shift, at least a little, from the seller back to the buyer.
It's the perfect micro-example of all this macro chaos, isn't it? Even a market as strong as housing is starting to buckle under the pressure.
Exactly.
So let's try to synthesize all of this. The narrative of the week seems crystal clear. It started with this incredible domestic political overreach, challenging the independence of the Fed.
And that direct political threat led to a massive, quantifiable erosion of confidence. You can see it written in the price of gold at $4,600 an ounce.
And that instability is now driving our allies towards self-interest and fragmentation. You see that in Canada's AE deal with China. When your leader is unreliable, you make your own deals.
I think the overarching analysis is this. The market is finally pricing in the real cost of political chaos. When your core institutions are threatened and your alliances start to fracture, capital will flee, and it will flee aggressively. The biggest financial risk of 2026 isn't a recession, it's political overreach.
Which brings us to our final provocative thought for you. The sources all confirm it. Gold and silver are spiking because of chaos, fear, and a loss of trust in the dollar. Gold is over $4,600. Silver is up 15% this week.
It's a historic flight to safety. So the question we have to ask is this. With prices this high already, is all that fear already priced in? Have the markets fully digested the risk of what's happening?
Or, given that the underlying causes of this chaos, the Fed drama, the U.S.-China tensions, our allies hedging their bets, are all structural and ongoing. Is this $4,600 gold price just the beginning? Is this the start of a true sustained loss of global confidence in the entire U.S.-led financial system?
Is the market just reacting to today's fear, or is it trying to price in a much deeper collapse of trust that's still to come? We'd encourage you to think about how your own planning is hedged against pure political risk.
Because right now, that risk factor has never been higher. Something to think about this weekend. We'll be back next time to dive deep into whatever sources you send our way.